Natural gas futures are edging higher on Wednesday as traders lock in profits following a sharp, multi-day sell-off. After tumbling from a 3-year high on December 5 to a 7-week low by Tuesday, this rebound looks far more like short covering than the start of any genuine bullish reversal. Meanwhile, the broader backdrop remains soft. Fundamentals are weak, weather forecasts stay bearish, and sentiment continues to lean lower. For prices to sustain any upside, the market will need more than a mechanical short squeeze. The weather has been the dominant force behind the recent collapse. Latest forecasts point to much warmer than normal conditions across the western and southern U.S. through the end of December. Supply adds another layer of pressure. Lower 48 dry gas production reached 111.5 billion cubic feet per day on Tuesday, up 7.5% year-over-year, while the EIA has nudged its 2025 production forecast higher to 107.74 billion cubic feet per day, reinforcing the bearish tilt. Traders have priced this outlook in aggressively, explaining the steep slide over the past 2 weeks. Given that the market typically trades 10 to 15 days ahead, the current warm spell is largely baked in. However, unless colder risks emerge for early January, the path of least resistance still appears to be to the downside. Meanwhile, tomorrow's storage report is expected to show a much larger than normal draw of around 164 billion cubic feet. However, this outcome is already well priced into the market after the recent sell-off. Nevertheless, if the actual withdrawal comes in even modestly smaller than expectations, it could quickly disappoint bulls and act as a fresh catalyst for another wave of selling. In the current fragile setup, the market appears far more sensitive to bearish surprises than bullish ones, especially with weather and supply still leaning against prices. The short covering bounce off Tuesday's lows looks driven by positioning rather than any improvement in fundamentals. From a technical perspective, overhead resistance is well defined. The 50-day moving average at $4.46 is the first hurdle, with the 200-day at $4.69 looming above as the key trend indicator. Nevertheless, without a firm base of support or a meaningful shift in weather models, any upside attempts into these areas are likely to be met with renewed selling. For now, the market remains firmly in sell the rally mode. Unless prices can reclaim and hold above key moving averages or the weather models introduce a credible cold shot, rallies look vulnerable. On the downside, a failure to build support could reopen the door toward the $3.70 area. The broader trend bias remains bearish, even if the market is temporarily pausing to catch its breath. If you enjoyed the video, drop a comment, hit like and consider supporting the channel. It really helps keep things moving, and see you next time.